Mike, the markets are red. I think I just gotta sell.
Why are you so emotional?
It was my portfolio, man. It's bleeding. I just gotta cut my losses.
Listen, before you go and do that and sell all your stocks, why don't we go over the bear market survival guide?
Oh yeah, the bear market survival guide. I completely forgot about that.
I know.
With all the fear, uncertainty, and doubt around the markets, I just get so emotional.
Don't worry about it. Everything's gonna be okay. You just gotta stop being a bitch. If this sounds like you, we've got 4 common sense tips to get you through any bear market. We'll even show you what investment opportunities to look for during these times.
With that being said, don't forget to sacrifice the like and subscribe buttons to appease the market gods. We don't want to anger them.
Before we get right into our survival guide, we have to put market declines into perspective, as they happen more often than you think.
A report by Charles Schwab shows that a decline of at least 10% occurred in 11 out of 20 years between 2000 and 2019, which is 55% of the time.
It also shows an average pullback of 50% after these declines, and the market still showed positive returns in all but 5 years. So Max, what does this mean?
Well, simply put, the market is cyclical. It's going to go up and down as part of normal market behavior. This brings us to our first tip in our bear market survival guide, which is don't panic.
In a recent interview, Kathy Wood explained what keeps her up at night.
Was it the spicy Thai food, Mike?
Not quite, just watch the video.
What keeps me up at night is knowing that some people are going to panic if they're looking at their accounts on a day-to-day basis. Almost every time I talk, I say we have a 5-year investment time horizon.
She's genuinely worried that investors will do the wrong thing in the short term, but she's looking at longer-term investments, and if you are too, don't sweat the short-term price fluctuation.
Oh my God! Okay, it's happening. Everybody stay calm. What's the procedure, everyone?
It's natural for us humans to fear loss, and unfortunately, a behavioral economics paper titled Prospect Theory reveals that most investors feel losses cause a greater emotional impact than gains do.
This suggests people are more likely to sell to stop further losses in a down market.
What? Oh no!
But if you're a long-term investor, panic selling on the worst days of the market is only going to compound your losses.
So what should we do? Well, you keep calm and you invest on. Historical trends have shown that bear markets are almost always followed by bull markets.
If you're about to panic sell, take a step back and look at the big picture. And always remember, when in doubt, zoom out and stay calm.
Now that you're calm, let's move on to survival tip number 2, which is something that most investors should know by now, and that is dollar cost averaging, even in a bear market.
Dollar cost averaging just means to invest regularly, regardless of market conditions. It's difficult to explain why, but some investors don't seem to equate buying stocks on sale the same way they would when big screen TVs go on sale.
And this is where a lot of investors miss out on huge opportunities for bigger returns down the road. If you believe in your investments, why wouldn't you want to buy them at a discount?
I have no idea. Dude, I don't get it.
A slow market is no reason to do anything different than normal. Keep investing in your portfolio, as you always would, and again, keep the emotions out of it.
To help you understand how important it is to stick to your investments through the ups and downs, Max, give them some stats.
Well, according to Bank of America, from 1930 to 2020, missing the 10 best trading days per decade would show a return of about 28%, whereas investing throughout the ups and downs would return an astounding 17,000%.
This just reinforces that dollar cost averaging is far greater than time in the market, especially in a bear market.
Moving on, our third survival tip is to hunt for value while prices are down. One of Warren Buffett's most famous sayings still holds true today. Be fearful when others are greedy, and greedy when others are fearful.
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news.
The best way to be greedy when markets are down is to find stocks with great value. Aristocrat dividend-paying stocks that are on sale are a great place to start.
The Aristocrat Dividend Club is a list of 65 companies, all worth over $3 billion and have at least 25 years straight of increasing dividends.
Not all dividend-paying companies are the same though, as dividend payouts can be reduced or removed, especially in bear markets. This is why we like Aristocrat dividend-paying companies when markets are down.
Not only that, Aristocrat companies offer products and services that many of us use every day. This makes them valuable not only for their dividend income, but also because they're able to keep strong earnings during slow markets.
Another way to find undervalued stocks is to look for companies that are trading around their 52-week low, but are still showing good revenue, cash flow, and earnings.
If you can find some of these gems with great financials in a bear market, you might want to take the opportunity to buy these companies on sale. When the market rebounds, you'll be glad you did.
Really? Oh.
Our last survival tip is to reassess your portfolio and increase your knowledge. In times of instability, it's always a good idea to revisit your portfolio and make sure your investments match the amount of risk you're willing to take.
Most financial advisors only recommend rebalancing your portfolio to match your future investment goals, as this can incur unnecessary fees and taxes or be similar to timing the market.
The most important thing is understanding your investment behavior during unstable markets to avoid making poor investing decisions. If you need stable investments that might not return as much profit, it may be the best option for you.
The reality is, not everyone can deal with high risks. Also, not everyone has the time or patience to figure out exactly how to micromanage their portfolio.
Seeking the advice of a professional advisor may be worth the extra fees, as they can usually steer your portfolio in the right direction and help to keep your emotions in check.
For those who want to take control of their own portfolio without the extra fees, definitely look into reading books, internet resources, or get a robo-advisor. Robots don't act on emotions yet.
Frustration loading.
Research and knowledge are power. If you're feeling uneasy about your investments, spending time to learn as much as possible will pay off in the end.
Just remember to act rationally, keep your emotions in check, and look at the big picture. Also, be on the lookout for discounted investment opportunities.
Those are our 4 survival guide tips. Make sure to like, comment, and subscribe.
With that said, he's Mike.
And that's Max. And we'll see you guys next week. So how's your portfolio looking now?
Well, I watched the bear market survival guide, and I didn't panic.
See, I told you, man. It's that easy.
You just ignore it for a little bit.
Yeah.
Next thing you know, it's back up.
Just like that. Ending clips.
Mike, the markets are red. I just get so emotional.
Don't do it, man. What you gotta do?
It's back up.
Really? So you gonna buy anything special?
Well, let's see what's on sale.
Oh, okay. Toilet paper?
Yeah.
Where were we?
I don't know. It's back up.
So, are you going on vacation?
Yeah, I'm going to Mexico.
How's your portfolio, man?
It's pretty good. I just read the survival guide.
All right.
I didn't panic.
You mean you didn't watch our video?
I did watch the video.
Okay, and what'd you think?
I thought it was pretty